Our first speaker, Colin Jones, is going to take us through an overview of the changes. Colin is a partner in Ernst & Young's Business Tax Consulting Group with over 18 years in corporate tax advisory, structuring acquisitions, compliance and income tax issues for both Australian and foreign-owned groups with lots of M&A experience. We look forward to Colin coming to give us an initial overview of the presentation.
Thanks, Tony, and good morning to all present in the room and to those online. My task today is really just to give you an overview of these changes that were in the announcements, and later speakers will go into a little bit more detail as to what they mean for each particular period of the law. I guess we only have to think back just over a year when most of the speakers today and most of the participants today were present at the symposium down in Melbourne, where we tried to dissect and understand this new asset called a right to future income, an asset that was introduced by the House of Reps in the February 10 amending bill and was substantially changed by the Senate on its passage through May 10. We also identified the changes to the residual tax cost setting amount or revenue asset treatment on the 70155.6, and asked the question whether the new amended provisions really did just keep the intent of the original section or went beyond. We fast forward almost a year, and up on the slide now is an extract of the Board of Taxation paper to the government identifying the amount of claims that were identified by the Tax Office at that time falling under either the right to future income or the residual tax cost setting amount. And it's in response to those claims, and it's fair to say that the Tax Office hasn't conceded on all of those claims, nor is it probably fair to say that they represent all of the claims that taxpayers were considering or have applied for. But what it does identify is a hole in the revenue that the government tried to respond to, and I think the response is beyond simply the unintended consequences of the law, but also beyond the cost of the intended consequences of the law. So we are seeing in this announcement both a paring back of where taxpayers have gone beyond what the government was expecting, but also a paring back just because of the revenue impact. Put briefly, these rules break up time periods and apply different versions of the law. And each of the later speakers will go through each of these in more depth. But essentially, when legislated, these announcements will create a set of rules called the modified old rules. Those are the rules that were in place before the February 10 announced changes. The transitional period, which is basically your sweet spot, if you had an amendment, which is really covering off where taxpayers acted on the law that was in place between May 10 and March 11, and the period after March 11. And March 11, of course, was the date that the Board of Taxation was asked to review these changes. I guess if I leave nothing else today, I'm going to try and help you identify for you or for your companies or your clients which of these rules apply based on the particular joining times. And in determining that, there are basically four factors that will be taken into account. The first is whether or not you have a private binding ruling or written advice under an advanced compliance agreement, the time that the joining entity joined the group, the time that the arrangement was entered into that resulted in the joining entity joining the consolidated group, and whether or not you had a notice of assessment or notice of assessment, amended assessment within a particular period. So we've affectionately called this the roadmap, and I think the first question is, did you have a private binding ruling that was issued before 31 March 2011? If you do, or you have a written advice under an advanced compliance agreement, then that's the law. You get to keep whatever that is. And that applies not only to the claims covered by the current years, but also to the tail. So if you had a right to future income claim, the future deductions. If your answer to that is no, and that represents about 99.9% of the taxpayers, then you've got to ask yourself the question, what was the arrangement time?